Okay, so we're going to teach you how to read an income statement. Um, First of all, it's important to understand that all income statements are going to be presented to you in the same way. First of all, on top, there's going to be a header that's going to give you a little bit of information. It's going to tell you, first of all, that this is an income statement, and it's going to tell you which company it's for, and it's going to tell you the fiscal year end of that company. And typically, not always, but let's just say it's true for the vast majority of time when you're looking at an audited financial statement, it's going to cover a 1 year period. So you can assume that whatever information you see in terms of sales and expenses and whatnot is incurred over the course of a whole year. Okay. Oftentimes it's going to have 2 years. The year that we're going to talk about, that basically the year of the financial statement, but it's also going to have the prior year. And the reason for that is because the prior year is the most relevant comparison so that you can gauge kind of how the business is trending. So, for example, in 2024, this business made 100,000, and in 2025, 121,000. So you know that sales went up. And similarly, you can kind of make some assessments about expenses and whatnot. So the other thing that you need to understand is that all income statements are going to be presented to you in the same order, in the same way. So you might have heard of, if you listen to CNBC or any financial news, that they refer to things called the top line revenue and bottom line earnings. So at the top, you're always going to start off with revenues. It's going to tell you how much in sales that the company made before deducting any kind of expenses. And then in the middle, obviously the income statement is not going to look like this, but this is just to help you understand from a very high conceptual level how the income statement is laid out. So in the middle is going to be expenses, okay? So right now, this is a very simplified version of an income statement, and it just has expenses in one line. But when you actually read income statements, there's going to be like a shit ton of stuff in the middle, and that stuff in the middle is going to be different expenses, a lot of different kinds of expenses. So those expenses are peeled back one layer at a time. Think of an onion, and we'll get into it a little bit later. Hopefully, I can explain it in a way that makes sense. After you deduct all expenses, you're left with profit. This is oftentimes called earnings. So, what earnings are? Well, like I just said, is revenues, like whatever's left of revenues after you deduct all expenses. And it's important because that's what the company keeps and can decide what to do with at the end of the day. So yeah, that's basically the high level layout of how an income statement is going to look. And just keep in mind that it's always going to be in this order. It's going to start from the top. It's going to be revenues or sales, and then it's going to have all the expenses in the middle. It's going to deduct it, one layer at a time until it reaches the very bottom, which is profit, or you're going to see net income, or some people refer to it as earnings. So now we expand the income statement a bit and start to peel back the layers. So recall that previously at the bottom we called this profit, but the the name that you're gonna see on an actual income statement for the very bottom line is going to be called net income. At the top, the revenues are still the same. So what's actually changed is this stuff in the middle. So we're going to peel it back one line at a time. So first of all, cost of goods sold. So if we think about like a company, let's say a lemonade stand, something very simple. For you to make the lemonade, you cannot not have the ingredients that make up the lemonade that you're selling. So that is going to be called cost of goods sold. Sometimes it's called cost of sales. So just there's the two different names for it, but essentially cost of sales sometimes is used where the revenue is kind of the company is selling a service. For example, let's say a haircut or maybe something like tourism, where the key cost of that is going to be salaries to the employees, right? You're going to pay somebody to give a service and you're going to make the revenue. That's more like cost of sales, which is going to be the wages. But in the case of a lemonade stand or you're selling lemonade, it's going to be cost of goods sold because you're selling a product and the product is lemonade. So cost of goods sold for a lemonade stand is the ingredients of the lemonade. Without this cost of goods sold, without this expense item, you cannot make the sale. So that's why it's the first layer of the onion or the first level of expense. When you deduct cost of goods sold, you get gross profit. Okay, gross profit is important because a gross profit tells you how profitable how profitable this business actually is. So if you think about like a service industry business, like tourism, for example, let's say you're selling a tour for $100 per person and you have 10 people, that's $1,000, right? But you're only paying the tour guide, let's say like $25 an hour. You can tell that the profit margin or gross profit margin is going to be very high. Okay, um, some things like Costco have very thin margins. You might have heard when people refer to margins, they're talking about usually gross margins. So whatever gross profit there is, that's what you have left to work with to cover all of your operating expense, which are like kind of the next level of expenses. So when I think about gross profit and cost of goods sold, in my opinion, these are very hard to change because this is essentially what product or service you're selling. And unless you can modify the cost of goods sold, typically the gross profit and revenues are harder for you to change. It's like you're kind of at the mercy of the environment, the economic environment, if you were the business. But the operating expenses, which is the next layer we're going to talk about, is kind of easier to change. So when we think about operating expenses, it's not really like for a lemonade stand. It's not really then the ingredients that go into the lemonade. The operating expenses would be like if you hire a kid to run the lemonade stand or you rent the lemonade stall. These are things that kind of you have more control over. For example, you can hire like one kid, you pay him like maybe minimum wage, and another kid, maybe you pay them like a little bit more. Like you can negotiate the salaries with the employees that you have. You can also choose which lemonade stand to rent. Some of them more expensive than others. So that's why this operating expense line, in the context of a business, can be changed by the business owner. Okay, so that's why this is a second level of expenses. And when you deduct this, both this and this, you end up with operating income. Okay, so operating income is more peeled back. Like the onion is like, like you're taking off two layers at this point. Third is called other expenses, and it might also be income. Okay, these are completely unrelated to the business. So oftentimes when we analyze like an income statement and this other expense line item is really huge, we really kind of it's not as important because they're usually one-time items. Like for example, back to the lemonade stand example, if you're running the lemonade stand and let's say like you have some insurance and somebody drinks the lemonade and they get sick and you have to kind of pay them out, they sue you, you pay them out. That's usually like a one-time event for that year, unless there's something wrong with the way that you make lemonade. You're not going to incur that expense every single year. So the other items, and similarly, if it's an income, because it could also be an income, like let's say you kind of use the funds, like you're running a lemonade business and you have some extra like free cash and you use the cash to trade stocks, something completely unrelated to the lemonade stand. You can't really kind of, and you make a bunch of money that year, you invest in crypto or whatever, you can't really count that as an income that's related to the business itself. Okay, so as you get down to the very bottom with the other expense and income item, like it's not going to be related to the fundamental business, if that makes sense. So once you take out the other expense or income, you're left with almost the core of the onion. You end up at earnings before taxes. Okay, so this is essentially what you have at the end of the day. But of course, because there's taxes, you have to deduct taxes, and that's the last expense. Now, the reason why, and we'll get into this in more detail later, why EBITDA, you might have heard of EBITDA, is before taxes. It's because the interest expense, or the amount of money like this EBT here, and can be used to pay off your loan first before it gets taxed. Okay, like interest and principal payments are an expense or an obligation of the business, so you have to deal with that first, and whatever's left over then is earnings before taxes, and it gets taxed. So that's why EBITDA, we kind of take the amount of money that is before the income tax, because it reduces our overall profit, like before the government comes to take taxes. And then once you deduct the income tax expense, you get net income at the very bottom. Hopefully I didn't confuse you with that EBITDA kind of concept right there, but I felt like it's important to understand why people talk about EBITDA so much. EBITDA stands for earnings before taxes. Like you see how here EBT, that has most of the EBITDA in there, but it's before interest, taxes, depreciation, and amortization. Okay, we'll explain that in a later video, I think. But this is kind of how you peel this income statement onion. And we'll get to kind of a few more points, and then that should be good to go. All right, so compared to the previous slide, this slide doesn't really get any more complicated, right? Like remember, revenue, cost of goods sold, gross profit, operating expense, operating income, other expense, earnings before taxes, net income, income tax expense. All of these are, you've seen these before. But what's going to change now is the stuff here kind of gives you all the individual items that comprise the operating expense that we talked about. And it's important to break it out because, like I said earlier, the operating expenses are things that can be changed, that the management team at a company can address. For example, salaries and wages, right? You can address this. Advertising costs, you can either choose to advertise or not to advertise. Rent, you can maybe switch the place that you're running your business from. So these are all things that, like it's going to give you more granularity as to what those operating expense items are. Whereas cost of goods sold for a business is usually like you're going to know what it is. Sometimes the cost of goods sold is also broken down further. For example, if you had that lemonade stand we talked about, the cost of goods sold might be broken down into 3 items like sugar, water, and lemons. Okay, but usually it doesn't. Okay, but the operating expense, for the vast majority of times, you're going to see it broken down. It could have more line items than this or less, but ultimately what is listed here is unique to the business, and you're going to have to just read what item it is and how much it was to figure out like how it relates to the business. So kind of a tip on how you're going to interpret the operating expenses is when you compare it from one year to another. Let's say the salaries went from 2024 is 6,200. Let's say it suddenly went up to like 20,000 or something. You're going to ask like, why did the salaries go up so much? If you don't see, like, for example, the revenue stayed relatively consistent, but then the salaries went up a lot, you're going to ask the question, why, right? So this is really like you're going to pick out some of the items that changed the most from last year to this year. And then you could potentially pose the question to the company, like, why? Why did this change so much? And likewise, for the other items, it's going to break it down into what those things specifically are. In the vast majority of cases, for commercial banking at least, the other item is going to be either foreign exchange or it's going to be they're going to have sold like one of their equipment or properties, and they're going to get some money out of it. Okay, so for example, in the case of the lemonade stand, let's say like they want to change their lemonade stand that they're kind of borrowing to run their lemonade stand. So they sell their old one and buy a new one. So if they sell their old one, that's going to appear in the other expense or income items, because it's not related to their business. Their business is selling lemonade. It's not to sell lemonade stands. And also foreign exchange, unless the company's business model is to trade currencies, usually foreign exchange losses and gains are considered other items. Now, this is usually like you need to consider this separately than how the business performed up here, okay? Because like I said before, the other expense items and income items, they're not related to the core kind of fundamental business model, like what makes the business money, right? Think about if Starbucks, you instead of making most of their profits from selling coffee, they suddenly were like selling, let's say, selling clothes, right? That would be a concern. So that's why, of course, you're going to take a look at whether there's any significant items in the other expense or income, like in this area, but this is not as important as what's up here. Okay. And then, of course, everything else below is the same. So I was trying to keep it under 10 minutes, and this is the last slide, but I felt like some things needed a little bit more context. So hopefully I haven't lost you yet, and we can just wrap it up here. So this is really to introduce some of the three most important kind of ratios that you're going to need when it comes to income statements and analyzing them. These are all for 2025. So we're just calculating them for 2025. And they're often called profitability ratios because we're really assessing how profitable the company is. And that's very important to understand, right? Based on from their income statement. So it's color coded, but everything is based off of revenues highlighted at the top. So everything is going to be divided by revenues. You're going to notice in the formulas here, gross profit margin is gross profit divided by revenues. Operating margin is operating income or operating profit divided by revenues. And then profit margin or net profit margin is net income divided by revenues. Essentially what it's telling you is how, like, as you go down the income statement, how much of that original sales revenue are you actually retaining? Okay. And obviously the higher the percentage, the better. But the different margins here mean different things. Okay. So gross profit margin essentially tells you, I would think of it like how profitable the business model actually is. For example, if you're selling if you're selling lemonade, let's say, or if you think about Costco, the gross profit margin is usually pretty thin when you're selling like something that's widely available, and basically now we're getting into like kind of if you're selling a commodity, like if you're selling an orange or something that is very common, the margin is going to be very thin. It's not going to be 55%. It's probably going to be like 5%. But then if you're selling something highly specialized, like a chair manufacturer, for example, the margin is going to be higher because, there's different qualities of chairs, and even cars, for example, they're highly differentiated amongst each other. And that comes to some of the other economic theories that we won't cover here, but you kind of get the gist of it. Like this first blue, like gross profit margin tells you like whatever it is that you're selling, how profitable is it? Okay. And then the operating margin is how well you can manage, operating your business. And that's specific to each operator. Like, for example, if you're running a lemonade stand, like let's say ABC Manufacturing Limited is running a lemonade stand, but then you have some other company also running a lemonade stand, their operating margins might be different because one lemonade stand might have way higher, they might pay their workers way more. The other one might might not. So then, of course, the operating margins is going to be different. Operating margins really incorporate the expense, like a vast majority of the relevant business relevant expenses into the equation. Okay. And then net profit margin, I would say it's a little less reliable, like when you think about how good the business is, than operating margin or gross margin, because it also incorporates other expense items. So let's say, like I talked about, like let's say you use some free cash of the business and you trade some stocks or make some investments, and then you invest in crypto and you make a lot of money. But even though your profit margin went up, maybe if you're selling lemonade, maybe like the revenue you get from lemonade, it went down a lot, but you have all this random income from cryptocurrency. It's not going to be a reliable indicator of the sustained profitability of your lemonade stand, because net profit margin incorporates that other expense or income item. And likewise, if you incur like an expense in a year, let's say somebody sues you, right? The lemonade gave them diarrhea or gave them the stomach flu, and they sue you and you have to pay them out. That's also not an expense that you can expect every single year. So that's something to consider as well when you're reading an income statement. Like the stuff that you see in here, and sometimes the stuff that you see in here, can it be rectified on a going forward basis? And we call that pro forma. Pro forma means like on a normalized going forward basis, how is the expense item going to look, right? So let's say 1 year, like salaries and wages, let's say it's 50,000, and then you ask the business owner, like, why is it 50,000? And they say like part of that salaries is that they pay themselves a bonus, and then they recorded it as salaries for themselves, but they usually don't take a bonus. So then when you do the analysis, you can actually reduce the expenses by 50,000 if they say they took a 50,000 bonus, and it won't happen again. You kind of see where I'm going with it. So yeah, like these are kind of the most important profitability ratios. You can kind of try to remember it, but it's very simple. Like when you see an income statement, and this is like literally the format of the income statement, it's going to calculate gross profit, operating income, net income for you. Sometimes it'll even have percentages here, but for commercial banking, it probably doesn't. And you can just divide, like in the blue, it's just like gross profit divided by revenue. In the orange divided by yellow. Purple divided by yellow. Okay, everything divided by yellow. And the reason for that, again, is how much, as you go down the income statement, how much of the original revenue are you retaining? So I hope this was helpful. Sorry it went 20 some minutes, but if you have any questions, feel free to ask. And if there's something that I didn't explain well, I'm happy to go deeper into it. So hope this was helpful.